Hello everyone, welcome to today's technical analysis lesson from Ichimoku.co. Please remember to visit Ichimoku.co for further lessons and for free daily analysis of various markets, and also join up as a gold member where you can have daily analysis from multiple markets delivered to you at the close of trading or very soon after the close of trading. Today we're going to look at the concept of divergence, and this is a concept that beginners find very difficult to grasp, and it is really quite simple. There are various types of divergences, but I'll just concentrate on the most common one today. So what is divergence? So with divergence we actually use a price chart, and then we use another subchart. The price chart can be either a candlestick chart or a bar chart or just a line chart, and the other subchart will be an oscillator, and an oscillator is an indicator that shows us what the momentum of the market is. The most commonly used oscillator is the RSI, and that's the most commonly seen oscillator that people are talking about when they're talking about a divergence. Now we see divergence between price action and the oscillator when the direction of the swing in price action is not reflected in the direction of the swing in the oscillator. So they're doing something different, and that's where the concept of divergence comes about. So they're not doing the same thing, they're not moving in the same direction. And that gives us a warning signal about the market. Now basically, because we're using an oscillator on the bottom, and that's a measure of momentum, it tells us, when we have this divergence, it tells us that the momentum that we have in the market at the moment is not the same as it was previously. And that says something about the strength and the commitment of either the buyers or the sellers in that from that previous period. It tells us that the market is not as healthy as it perhaps was, and very often it's difficult to see that just on a chart, and sometimes we can pick that up quite easily with divergence with an oscillator and a price chart. Now we have to be careful when using divergence as well. Never use it by itself. All that the divergence is telling us is that something's not quite right. So if you're in, say, a downtrend and you see a divergence, we may not see a defined change of trend to the upside. So don't go placing your bets on the trend changing. We could see a change of trend, but we don't always. What we could just see is a pullback, and it could be a minor pullback, and then the trend could exert itself back in the other direction. Now the important thing when using this technique is to always combine it with your use of trend following indicators. So if you see that divergence, go and have a look at the trend following indicators. If you see some other signals there that are saying that the trend is weakening, then yes, perhaps, and wait for another signal to take to trade perhaps in the other direction once that change of trend is confirmed. But the good thing about the using the divergence with the oscillators with these momentum indicators is that we can get fairly early warning of a potential change of trend, and as a trader what we could do is either tighten our stops or take profits on a position that we may already have. Now we call a divergence either a bullish divergence or a bearish divergence, and they're used in a predictive nature. So if the market is in an uptrend, we say that we may have a bearish divergence because we're predicting that we could see some bearishness enter the market. If we have a downtrend, we say that we have a bullish divergence if we see one, and we're actually suggesting that we could see some bullish price activity. Now here is what happens when we have a bullish divergence. So when we have a bullish divergence, we have the market in a downtrend. The market is actually trending down. So because that's the bullishness is predictive in nature, we're looking for some buying activity to come into the market. So what the price is doing is that the price is making a series of lower troughs. So the price action makes a lower trough, but the oscillator, the momentum indicator, makes a higher trough. And here's what it looks like on the right hand side. Here we have price action trending down. We define trend as the market making a series of lower peaks and lower troughs. So here's a peak, a trough, lower peak, lower trough. Here, however, on the oscillator, the market makes a trough in line with the trough on the price action, but the trough here where we have the lower trough in price action on the oscillator is higher than the previous. So we draw lines. We tend to draw these lines to highlight that those troughs there on price action are moving down, and then those troughs on the oscillator are moving up. So this is predicting that we're likely to see some decent bullish activity, and it's warning us of a potential change of trend, always confirmed however. So what this is actually telling us is that because the reading here at this trough on the oscillator is higher than it was at this point here, it tells us that at that point here where the market was actually pushing down lower and everything looked well with the sellers, they were in control, the underlying market wasn't actually supporting that. The depth of the market, the acceleration of the market, the momentum of the market was not as great as it was previously, and that's why we get that warning. Now with the bearish divergence we have the opposite. With the bearish divergence we're in an uptrend, and by saying bearish we know that we're predicting that we may see some bearish price activity. So what we have is with price, it's making a higher peak, but the oscillator is making a lower peak. And here's what it looks like on the right hand side. We have an uptrend in place in price action on the top here, the market making a series of higher peaks and higher troughs. Here's the higher peak, but when we look at the oscillator, it actually makes a lower peak for that second peak. So there's the two peaks that we're comparing. On the top here, once again, we draw that line across to reflect the higher peaks in price action. Everything looks healthy in the trend. But looking down below to the subchart with the oscillator, the momentum indicator, we look at the peaks here. The first peak looks normal, the second peak is lower. We draw the lines across, and that suggests that the trend is not necessarily healthy, the internals are not healthy, and that perhaps the buyers here in this case are not as strong as you'd like them to be. This here, actually the second peak on the momentum indicator shows that momentum is lower than it was at the previous peak, and it's something that we might not necessarily see on the price action chart, and that serves as a very important warning to either be prepared for a change of trend, look to your trend indicators and wait for a signal, or if you have a position, to look at perhaps raising your stops, or to perhaps look at taking some profits. So just looking at a chart of NYMEX oil, and here we see a recent divergence here, and here we see price action trending down, and here we have the market making a series of lower peaks and troughs, and the one we're interested in here is this trough, and this is a bullish divergence, and here we see the trough here, a lower trough on price action. We draw the lines across to reflect the lower troughs, and in this case on the bottom we have an RSI, and here we see a trough and a higher trough, and we have a warning of a some potential bullish activity. Now this is an important chart because we didn't see any decent upside in this market. In fact, technically the trend didn't even change, and this serves as a very good example that be careful with divergences. They don't always lead to changes of trend, and they don't always lead to a substantial retracement. Looking at our indicators here, this trend is very healthy to the downside. Now, one of the indications here of a potential bullish move in this market would have been the market perhaps breaching up through the Tenkan-Sen indicator, and we haven't seen that at all. What we actually saw was the market go on to make another lower trough. At the moment it looks as though we could see a higher trough on the momentum oscillator, but that could actually tick down. That last piece there that has moved just up hasn't actually formed a trough yet, because that last candle there is still forming, so we can't preempt the market. So what could happen is that the oscillator could continue back down. If we do see a formation of another trough there and another higher trough here on the oscillator, that would be what we call a triple divergence, and they tend to be fairly strong indications, but once again always looking to our charts, our price action charts, to tell us something. And here, as we saw with this first bullish divergence, we didn't see any indication that the trend was going to change. We saw the market trading down below each of the Ichimoku indicators, and what it warned us though perhaps was to lower our stops perhaps close to the Tenkan Sen, depending on your time frame that you're trading in, or even to perhaps take some profits. Even taking the profits in this situation could be really wasting those profits. So that concludes the analysis lesson, technical analysis lesson for today on the concept of divergence. As I mentioned, go to ichimoku.co for further lessons and to view the analysis that's available there, and to join up as a gold member.